We are looking at Beyond Meat, ticker BYND. Right now, the market is active and the stock is hovering dangerously in penny stock territory, trading at approximately 86 cents per share. The stock is flat on the day, showing virtually zero movement at the open, but do not let that stagnation fool you. Beneath this flat line lies one of the most volatile, diluted, and contentious equity stories on the NASDAQ right now. If you are looking at this 86-cent price tag and thinking it looks like a cheap lottery ticket, you need to pause and listen very carefully because the situation here has fundamentally changed in ways most retail investors are completely missing. The expectation right now, the narrative floating around Reddit threads and speculative Discord servers, is that Beyond Meat is setting up for another massive squeeze. Investors see the price under $1, they remember the glory days of 2019 when this stock traded above $230, and they think, how much lower can it go? It has to bounce. That is the expectation. Here is the reality. Beyond Meat is not just down. It has been fundamentally re-engineered through a massive dilution event that has flooded the market with hundreds of millions of new shares. The stock you are looking at today is not the same asset it was 6 months ago. The pizza has not just gotten smaller, it has been sliced into 5 times as many pieces, and most people buying at these levels are unaware they are eating crumbs. We need to dissect exactly what is happening with this price action because it tells a terrifying story of capital destruction and survival financing. Looking at the intraday chart, we see a stock that is gasping for air. It spiked recently. Remember the October madness where it hit nearly $7.70? That was a classic, violent short squeeze combined with retail hysteria. But notice how quickly it collapsed. It didn't just drift down, it cratered back to sub-dollar levels. Why? Because that rally was sold into by the company itself and its creditors. When a stock spikes 300% and then immediately gives back 100% of those gains to sit at an all-time low of 86 cents, that is not a correction, that is a rejection. The market is telling us that at any price above $1, there is a wall of sellers waiting to exit. Let's talk about the immediate price mechanics we are seeing this Monday. The stock is pinned below the $1 mark. This is psychological and structural quicksand. When a company listed on the NASDAQ trades below $1 for 30 consecutive business days, it triggers a deficiency notice. Beyond Meat is now dancing on that razor's edge. The 86-cent level is critical because it represents a complete loss of institutional confidence. The big money, the pension funds, the long-only asset managers, they cannot own stocks trading at these levels. They have mandates that force them to sell. So what you're seeing on the tape today, this high-volume churning at 86 cents, is likely a rotation from institutional holders to retail speculators. This is a dangerous transfer of wealth. This brings us to the expectation versus reality of the business itself. The expectation is that Beyond Meat is a growth company hitting a rough patch due to inflation and changing consumer tastes. People think once interest rates come down or once they launch a new burger, the stock will recover. The reality is much starker. Beyond Meat has shifted from a growth darling to a company in survival mode. The recent financial maneuvering, specifically the debt for equity swap, was a desperate measure to avoid bankruptcy. They essentially printed hundreds of millions of new shares to pay off bondholders. This is why the stock is 86 cents. It is not just sentiment. It is math. If you have a pizza and you suddenly cut it into 500 million slices instead of 60 million, each slice is worth a fraction of what it was before. The company didn't lose 90% of its value. It diluted 90% of your equity. I want you to verify this for yourself. Go look at the outstanding share count from a year ago versus today. It has exploded. This means that even if the company miraculously doubles its revenue next year, which is highly unlikely given the current macro environment, the earnings per share would still be negligible because there are simply too many shares outstanding. This is the dilution trap that catches so many new investors. They look at the chart, see the drop from $200 to 86 cents, and see value. Professional investors look at the market cap and the share count and see risk. Let's pivot to the short selling dynamics because this is what everyone wants to know about. Is a squeeze possible? Is the short interest high enough to trigger another explosion?
Currently, the short interest as a percentage of float is sitting around 14 to 15%. This is high, undeniably. Anything over 10% is considered crowded. But it's not the 40 or 50% powder keg that you might see in other meme stocks. But here's the nuance. The days to cover ratio is very low, hovering around 1.0. This means that based on the current average daily volume, shorts could cover their entire position in a single day of trading. This is crucial. A low days to cover ratio usually means a short squeeze is less likely to be sustained because shorts can exit the building quickly without trampling each other. But we have to look at the cost to borrow. Borrow fees have been volatile, spiking during the October rally and then cooling off. If you see the cost to borrow spike again, say jumping from 3% to 20 or 30%, that is your signal that liquidity is drying up and a squeeze might be brewing. But right now, with the stock flooding the market with new shares are relatively easy to borrow. This dampens the squeeze thesis. The shorts are not scared right now. They are looking at a company burning cash, with a broken balance sheet, trading under $1, and they are comfortable holding their positions. They are betting on a reverse split or further dilution, both of which would likely drive the price lower. Speaking of the reverse split, this is the elephant in the room. With the price at 86 cents, a reverse split is almost inevitable to regain NASDAQ compliance. Shareholders have already approved proposals that pave the way for this. Why does this matter? A reverse split, say 1 for 10, would take your 100 shares at 80 cents and turn them into 10 shares at $8.80. Mathematically, you have the same amount of money. But psychologically and historically, reverse splits are brutal for shareholders. They often signal distress, and they tend to be followed by more selling. Short sellers love reverse splits because the higher price gives them more room to short the stock back down. If you are holding BYND hoping for a recovery, you need to understand that a reverse split could be the catalyst for the next leg down, not up. Now I want to hear from you. This is a battleground stock and everyone has a different entry price. Comment below. Are you holding bags from the October rally at $7, or are you looking to enter now at 86 cents? And be honest, do you think the plant-based meat trend is dead or is it just sleeping? Let me know your average cost basis in the comments. I read every single one. Let's dig deeper into the retail sentiment because this is driving the volatility. If you check the discussions on Twitter or the main investment subreddits, the sentiment is fractured. You have the Diamond Hands crowd who believe that the environmental necessity of plant-based meat guarantees a comeback. They are pointing to the partnerships with McDonald's and Yum Brands to proof of life. Then you have the realists, the investors who have been burned, who are calling out the management for the massive dilution. There's a lot of anger directed at the leadership for the timing of the debt restructuring. Many retail investors feel they were used as exit liquidity for the bondholders. And frankly, looking at the chart, it's hard to argue with them. We also need to address the fundamental health of the business. Beyond Meat is still burning cash. Their latest earnings reports show negative gross margins in some quarters, though they are trying to claw that back to positive territory. But think about what negative gross margins mean. For every $1 of burger they sell, it costs them more than $1 to make and ship it before they even pay for marketing, R&D, or headquarters. You can't make up for that on volume. They have been cutting costs aggressively, shutting down production lines, laying off staff, reducing inventory. But you can't cut your way to growth. You have to sell products. And right now, U.S. retail demand for plant-based meat is softening. Inflation has hit the grocery aisle hard, and when consumers are choosing between expensive plant-based patties and cheaper ground beef or chicken, their wallets are making the decision for them. The macro environment is another heavy weight on this stock. We are in a higher-for-longer interest rate environment compared to the zero-rate era when Beyond Meat went public. Growth stocks, especially unprofitable ones, are valued based on future cash flows. When interest rates rise, those future cash flows are worth less today. This crushes the valuation. Furthermore, Beyond Meat has a significant debt load. Even after the restructuring, they have obligations. If they can't turn a profit soon, they will need to raise more capital. And with the stock at 86 cents, raising equity capital is incredibly expensive and dilutive. It's a vicious cycle. Low stock price leads to dilution, which leads to lower stock price. What are the actionable steps for you right now? If you are long this stock, you are in a high-risk speculation zone. You need to watch the 80-cent level like a hawk. If it breaks below 80 cents, we could see a flush down to 50 cents as stop losses get triggered and margin calls hit. If you are looking to enter, do not just blindly buy the dip. Wait for confirmation. Look for a break above $1 on high volume. That would show that the bulls have regained control of the compliance level. Watch the fail to deliver data. FTDs occur when one party in a trade fails to deliver the shares to the other. High FTDs can be a sign of naked shorting or administrative strain due to lack of available shares. If we see FTD spiking while the price is at these lows, it could indicate that the market is structurally broken on this ticker, which sometimes precedes a violent snapback rally. But don't rely on it. It's a secondary